This is Optimal Finance Daily, episode 2496. Can you remove PMI from your mortgage? By Michelle Schroeder-Gardner of MakingSenseOfCents.com. And I'm your host and personal finance enthusiast, Diana Merriam. We're going to get right to today's post as we optimize your life. Can you remove PMI from your mortgage? By Michelle Schroeder-Gardner of MakingSenseOfCents.com. Are you looking to remove PMI from your mortgage? According to the National Association of Realtors, the median list price for homes is $232,000. If you have PMI of 1%, that means you would have an annual private mortgage insurance cost of $2,320 or $193 per month. That's a lot of money. More people should think about removing PMI, as this money could be put towards a retirement account, funding an emergency fund, paying off debt, and more. If only I could rewind the last 7 years and listen to my own advice. In 2009, me and my husband bought a house, but didn't have 20% down. We were taking advantage of the low housing prices and the first-time homebuyers tax credit. One thing we didn't think much about was mortgage insurance and how it would affect us. Yes, we're human, and we made a mistake. While we no longer own that home, we're full-time RVers now, we do wish we would have found a way to not pay mortgage insurance. The reality is that a lot of people make this mistake when getting a mortgage. PMI can be bad because, one, it's expensive. PMI usually costs around 0.5% to 1% of a loan, and you pay that amount every single year. So if your mortgage is for $150,000, you may find yourself paying $1,500 a year in PMI costs. That's $125 a month. Number two, it doesn't protect you. Just because PMI contains the word insurance, it doesn't mean it's something that will help you out later on. PMI is for the lender, not you. And three, you can't always remove PMI. It's not easy to remove PMI from your mortgage. So don't think you'll just pay PMI when you first get your mortgage and then quickly remove it. We'll go through some of the steps. Here's what you need to know to remove PMI. Number one, what is PMI? First things first, we should probably go over what PMI is. PMI is mortgage insurance on your home loan. However, it does not protect you. Instead, PMI protects the lender in case the borrower stops paying their monthly mortgage payment. PMI is often required by mortgage lenders if you're putting down less than 20% of the home's purchase price. So if your home is $200,000 and you don't put down $40,000, you'll most likely be paying PMI on your mortgage. This applies to refinancing as well. If you're refinancing and you haven't paid more than 20% of your home's value towards your loan, you may have to pay PMI. Number two, you may be able to remove PMI from your mortgage. To remove PMI, you'll need at least 20% equity on your home. Once your mortgage balance drops to 78% and you've reached a specified date designated by your mortgage lender, your lender on a conventional loan is then required to eliminate PMI as long as you are current on payments. However, you may be able to remove PMI sooner. In some cases, you may be able to obtain a new home appraisal if your home has increased in value and you believe that you'll have more than 20% equity in your home. According to the Consumer Financial Protection Bureau, quote, the Homeowners Protection Act gives you the right to request that your lender cancel PMI when you've reached the date when the principal balance of your mortgage is scheduled to fall to 80% of the original value of your home. This date should have been given to you in writing on a PMI disclosure form when you received your mortgage. If you can't find the disclosure form, contact your lender. You can also make this request earlier if you've made additional payments to reduce the principal balance of your mortgage to 80% of the original value of your home, end quote. Number three, you may have to jump through some hurdles to remove PMI. Removing PMI from your mortgage isn't as simple as just giving your mortgage lender the amount that is needed in order to eliminate the extra cost. Sometimes you'll have to ask your lender to remove PMI from your mortgage in writing. You have to prove you're able to pay your bills and mortgage payment, and you may have to get an appraisal to prove that your property's value hasn't dropped below where it was when you first received your mortgage. Different lenders have different rules, so it's best to figure this out as soon as you can so you can start taking the actions required to remove PMI. And number 4, it's a little more difficult to remove PMI if you have an FHA loan. If you have an FHA loan and put down less than 20%, then you have a mortgage insurance premium, or MIP. This is very similar to PMI, except it applies to FHA loans. If you have an FHA loan closed on your home after June 2nd, 2013, and had a down payment of less than 10%, you are then unable to remove MIP from your mortgage. However, if you closed on your home before that date and have a 15-year term, you can remove MIP when you owe less than 78% on your home. You also may be able to get rid of MIP on your mortgage if you refinance into a conventional loan and have more than 20% equity. In the end, it's best to research your individual options, contact your lender, and see what steps you need to take in order to remove mortgage insurance from your home loan. This will then allow you to put that money towards something more important. You just listened to the post titled, "Can You Remove PMI from Your Mortgage?" by Michelle Schroeder-Gardner of MakingSenseOfSense.com. Labor strikes, climate change, your beat up office printer. What do they all have in common? Come on, it's all about the money. Economics is everywhere and everything fueling our lives, even where we least expect it. If you're a fan of Optimal Finance Daily and are curious to learn something new and exciting about economics every week, I recommend you listen to the Planet Money podcast from NPR. Planet Money is a different kind of world where the complex economy actually makes sense, where human stories supersede abstract theories. Listeners can learn, laugh, and be entertained. It's econ, down to earth, and Planet Money answers some of life's burning questions, like, will AI take over our jobs? Why are Christmas trees so darn expensive? The Planet Money team lives to tell a good story in around 30 minutes. It's econ for the rest of us. Tune into Planet Money every week for entertaining stories and insights about how money shapes our world, stories that can't be found anywhere else. Listen now to Planet Money from NPR, wherever you get your podcasts. When I bought my house, it was important to me to not need PMI, so I needed to get a little creative. I had the 20% down payment, but it was pretty much all the cash I had on hand, and I didn't want to part with all of it for obvious reasons. So what I ended up doing to avoid paying PMI was finding a bank that let me pay half of my down payment with a HELOC. I ended up paying that off in 6 months, and I only paid around $200 in interest. It was totally worth it for the peace of mind. However, I didn't realize that most home equity lines of credit have variable interest rates. It worked out for me in the short run, but I was shocked to see that in that 6-month period back in 2018, my interest rate went up 3 times, 3 freaking times. And that resulted in the interest rate being almost a whole percentage point higher than I thought I was signing up for. Boy, am I glad I paid that off quickly. And I do think this strategy only works for people that have the same ability to pay it off very quickly. But I figured I'd share how I navigated this, as I've never heard anyone else talk about this approach to avoiding PMI. And that will do it for today. Have a great day and start to your weekend. Thank you for listening, and I'll be back here reading to you tomorrow, where your optimal life awaits.